Thank you very much, Neil, and thank you all for joining us this morning. I'm going to split this presentation into sort of three bits. I'm going to look back at the last few years and just review the performance of the trust. I'm actually going to focus in on the bank sector. I've got some interesting charts to go through on the banks, because that has been one of the areas that has undoubtedly contributed to the strong performance of the trust. And then I'm going to finish by looking forward and sort of looking at where we are today, and where the market stands and so on and so forth. And I suppose I would just echo the point that Neil made, which is that a recurring theme throughout this entire presentation is I would just ask you please not to anchor off the start point of where we took over the trust. Try to look forward. Try to look at how things are today, and look forward. And I'm going to give you lots of examples of how extreme things were at the start. And the point I suppose I'm trying to make is that it's the wrong conclusion, I think, to think that you've missed the trust. So, further ado, let's kick off with performance. Performance has been very strong, as this chart shows. I actually updated this to yesterday. The performance now, in share price terms, since we took over, is 205%. The FTSE All Share Index total return over that period of time is 87%. So we've handsomely beaten the All Share Index. And just another interesting factoid for you is that the S&P 500 is up 110%. So we're kind of nearly double the S&P 500 as well. So three observations, I suppose, from that. Number one, in 2020, we'd come to the end of a decade, hadn't we, in which actually value investing hadn't done that well. Growth and quality investing has done very well, and lots of people were rushing out to tell you that value investing was dead and basically no longer worked. I think people wrote the obituary of value investing a little bit too early, and these figures would certainly tend to suggest that actually value investing is not dead and it still should play a part in your portfolios. That's the first point. The second point Neil mentioned, which is that again, you will have lots of people tell you that active fund management can't add value and therefore you should just go passive. You should just have all your money in passive funds. Just to reiterate the point, we've more than doubled the return of the index, so I think we can kind of put that one to bed. And then the final one is just this point about UK versus US. So as I said, we've nearly doubled the S&P 500, despite the S&P 500 obviously benefiting from the gains of the Magnificent Seven stocks. So you can make money in UK equities. And just one final observation on that. As we finish that 5-year period, the UK is still trading at one of the lowest valuations that it's been on for the last 50 years. The S&P 500 is trading on one of the highest valuations that it's been on for 50 years. So if you're thinking about where the returns might go from here, just those facts, those valuation dispersions would tend to suggest UK over US. So that's that. If we maybe move on. So this is the split of the portfolio today. You can see the largest sector there is towards financials. This is the top 10 within the portfolio, and I'm just going to make 2 points here. Number one is that I would say this is a collection of reasonably good businesses. Sometimes value investors can be accused, can't they, of just buying kind of cheap rubbish. I would not say this is a list of rubbish companies. I would say this is a list of reasonably decent companies. So that's the first point. The second point is that despite the fact that some of these stocks have done very well, the valuations today are very low. And again, I would just urge you to think, if you didn't know what the performance of the trust in the last 5 years and someone just presented you with that list of stocks, I suspect you would look at them and think, actually, that's not bad. So there are 5 of that top 10 have got a dividend yield of roughly 6%. And we've got lots of stocks on P's of sort of 8, 9, 10 times. So valuations are still very low, irrespective of the fact that performance has been quite good. So again, just reiterating that point, not kind of anchor off where we've come from. Let's move on and talk about the the banks, because I mentioned earlier on, this has been, one of the key contributors of the strong returns. And I think what's fascinating about this is that if you cast your mind back about sort of four or 5 years ago, there were certain investors who I won't name, but sort of some well-known quality growth investors were not only telling you that you shouldn't invest in the banks. I mean, some of them were actually using the term uninvestable. There was one famous quality growth investor wrote an op-ed for the Financial Times about 4 years ago, and he literally said that you shouldn't invest in banks at any valuation. And we strongly disagreed with that at the time, and we actually sort of wrote a riposte to what he was saying. And I suppose the point of this is not really to pat us on the back, but just to make this point about how low the start valuations were. So we've got three companies here: Barclays, NatWest, and Standard Chartered. And what we're looking at today is the share prices. Let's start with Barclays on the left-hand side there, and you could see that at the start of 2024, the share price was about £1.50. Barclays was about to report the earnings for the year ended 23, so obviously they report that in kind of January, February of 24. They were about to report earnings per share of 36p. So just reiterate that the share price was 150 and they were about to report earnings of 36p. So about 4 times earnings. NatWest in the middle there, share price at the start of 24, £2, about to report earnings of 53p. So those earnings were actually, those earnings were done. They were about to report them. So again, 4 times earnings. So yes, we can see that, if you look at the 5-year returns, the returns have been very, very strong. Barclays at 334%, NatWest over 500%. But the key point here is that the start points were absolutely ridiculous. 4 times earnings is just a ridiculous valuation for these sorts of companies. So that's kind of, I suppose, the first point. Now, the reason that they did so well was partly because the starting valuations were so low. But amazingly, you had this very rare set of circumstances in which the valuations were low at a time that the fundamentals were about to improve very dramatically. And that's what I want to cover in the next couple of slides. So if you know anything about a bank, they're basically, their profits are driven by 2 or 3 important lines. The first one is it's called net interest margin. So it's the difference between what they fund themselves at and what they lend out at. And what you can see here again is look at how that net interest margin was improving over the last few years. And of course, that's partly a function of the fact that we had come off 0% interest rates and interest rates began to rise over this period. And of course, that's helped for a bank's net interest margin. So at the top line, your net interest margin is widening, therefore profits are going up. Let's go down to the next line, which is the slides below. So this is the cost side of a bank's, their cost to income ratio. So at the same time the net interest margin is going up, the costs are going down. So you've got this sort of jaw effect in which your profits going up, your costs are going down, and of course that drops through to the bank's bottom line. Again, reiterating the point that at a time at which start valuation is very low. The next important line for a bank is loan losses. And of course, this is very, very important. We all know what happened during 2008. And again, this was something where if you look at the black lines for the companies, the black line is called the non-performing loan ratio. And again, we can see what was happening over the last few years. That line was going down. In other words, loan losses were reducing over this period of time. So profits going up, loan losses going down. Again, all of that feeding through to the bottom line of the companies. And we can see when you sort of add all that lot together, you can see what this did to the bank's profits. So this is just the top 3 charts of the earnings per share of the companies. Maybe let's start with NatWest in the middle there. Last few years, 40p up to 50p of earnings per share, and the forecasts are obviously even higher. Look at the returns that the companies are now making. Maybe again, if we look at NatWest in the middle there, NatWest are now making an 18% return on tangible equity. A very, very decent return on tangible equity. Lots of companies in the consumer staples sector these days would dream of making that sort of return. So profits going in the right direction and now making really attractive returns. This is the valuations, and again, we're just making the point here of how low the valuations were. The top charts are price to earnings ratios, and again, you can see the fact that these things were trading on sort of 4 to 5 times earnings a couple of years ago. The other ratio that people often use when they're looking at valuations of banks is called price to tangible book, and roughly speaking, if a bank is making something in line with its cost of capital, so if a bank is making a sort of 8 or 9% return on tangible equity, you'd expect it to trade at 1 times its tangible book. And again, you can see how low the price to tangible book ratios were a few years ago. And even today, actually, NatWest is just above 1. Barclays is still below 1, though. So on that basis, looking forward, the valuations do not appear really to have gone up very significantly over this period of time. And this is the final part of what caused the earnings and the share prices to go up so dramatically, and this is share buybacks. So the banks did exactly the right thing during this period of time. Their balance sheets were strong, their profits going in the right direction, the valuations were very low, nobody wanted to know them, and therefore they said, right, fine, we will start buying back our own shares. And they did this in size. So we're looking here at the black line. The black line, and if you use the right-hand scale, that's the share count in billions. So Barclays share count, go back to 22, was probably sort of 17.2 billion, something like that. Today, it's just over 14 billion. So that's come down about sort of 16, 17%. The standout here, though, is NatWest. If you look at NatWest, you've gone 11 billion down to 8 billion in just over 4 years. A reduction of 30% in the shares in issue. So in other words, even if the net income hadn't have changed over that period of time, your earnings per share would have gone up by 30% just because of the reduction in the share count. So you can see, all of the things going in the right direction for the banks over that time, and a very low valuation at the start. Now, I should say that because obviously we owned a lot of these things in the early days, they became a big part of the trust. So we do not think that they are expensive today, but we have been reducing them. They probably became sort of 7% each company of the trust. Therefore, I think 3 of the top 5 holdings were probably UK banks, and we thought it's probably sensible portfolio management to reduce them. So we have been reducing these things and recycling that money into other investments. We still own them. Still don't think they're expensive, but we've just taken some of the money off the table. So that's the banks. I want to now sort of maybe look forward and try to convince you that actually today's start point, I think, is still very interesting for a UK value investor. This one, I think, is just fascinating. The last few years, I think people have got used to it all being about investing in the US and specifically investing in the Mag 7. This year looks very, very different. So what we've got here, this is done at the end of July, and the numbers have gone up a little bit, but the order hasn't changed. And it's just the returns of different markets year to date. Should say this is in GBP, by the way. But you can see that the FTSE 100 has done 14. Some of the European markets sort of 17% or so. DAX up 20%, 26% year to date. And look over on the left hand side, Mag 7 up 2, S&P 500 up 3, Nasdaq up 4. So a very, very different picture this year to the one that we've seen in the last few years. And you can see something similar if you look at individual stocks. So let's start over on the left-hand side. Lots of the stocks which were just favourite investments of the kind of quality growth crowd for the last few years. So companies like LVMH, Novo Nordisk, etc., etc. And look at the returns year to date. Novo Nordisk has lost 2/3 of its value over the last year. LVMH has lost a quarter of its value. I mean, just returns, I think, that really, really surprise people when you show them Moderna over on the left-hand side. There's 75% of its value. And then look over on the right-hand side, what's done well this year. I mean, again, I think this just stuns people when they look at it. So sleepy old companies like BT Group up 56%, and banks like Barclays up 63%. International Consolidated Airlines, so British Airways, up 140% over the last year. So there has been an enormous rotation out of the old, the old quality growth darlings and into some of the value stocks. This is the performance of the US against the rest of the world, and it's a long time series. So this goes back to the 1970s, and we've marked on it I suppose the three bubbles of that period. So the Nifty 50 bubble, for those of you who know about that, it was not dissimilar to today. A group of stocks in the US that investors thought were so good that you could just pay any valuation for them. Didn't really matter. They'd always see you right. And it subsequently turned out not to be the case. Actually, if you bought the Nifty 50 in 1970, you had a horrible experience. TMT, I guess, lots of us will know about. I would again say there were some similarities between then and now. But just look at where we are today. The Magnificent Seven, relative to those two previous peaks, and we have just gone completely off the scale. If I said to you, right, you have to go away, come back in 5 years' time, do you think that the S&P has outperformed or underperformed? I suspect a lot of people would say, from today's start point, my guess would be it's going to underperform. And the final thought I'll leave you with is, I think people have sort of almost given up on the idea that the S&P 500 could ever perform other markets in the world. But just look at what happened after the Nifty 50 bubble peaked. The S&P 500 underperformed for 20 years. So it can happen. So just worth bearing in mind. This is a very long valuation of the S&P 500. The point here is that the S&P 500 is higher value today, basically, than it's ever been, which again, I think would argue for not having very large exposure to this market, irrespective of the fact that it's 75% of the MSCI World these days. Whereas flipping this round, and again, I'm trying to sort of bring this back to this theme about the fact that it's not all over. The chart on the left-hand side is the valuation of the UK relative to MSCI World. The 50-year average is that the UK has traded at about a 17% discount to MSCI World over that period of time. We got down to, I think it was about a 45% discount, something like that. And you can see that we've bounced off that level, but we are still trading a long, long way behind the 50-year average. So again, to me, that looks like we've started that correction process, but it's by no means over at all. And it's a similar story when you look at value versus growth. This chart takes a little bit of explaining. So let me explain what you're looking at here. You're looking at the spread in valuations between the cheapest and the most expensive part of the UK stock market. The valuations they use here are price to earnings, price to book, and dividend yield. And what you can see is that over time, that is not a straight relationship. Over time, it goes up and down. When the line is going up, that is basically growth stocks becoming more and more expensive and value becoming cheaper, and so on and so forth. You can see, if you look at the line going down into 2000, that's basically TMT. So that's growth becoming expensive, value becoming cheap. Eventually, you hit the sort of trough in 2000, and we have 5 years of very strong value outperformance. Look where we got to in 2020. Again, I'm trying to make this point about the start point. The start point in 2020, the dispersion between value and growth in 2020 was way wider than it was in 2000. And you can see clearly that we have bounced off that level. So that has been additive to our performance over the last 5 years. But we're not even back to the start level of 2000. So the start point was just so extreme that all we've started to do is sort of unwind a bit of that extreme. Last couple of slides from me, and then I'll pause and take questions. People will often say, well, yes, I know that the UK is cheap, but what's going to be the catalyst for the realization of this value? And in the last couple of years, we have seen two. One has been takeovers. So US companies in particular have been looking at the valuations of UK companies, and they just cannot believe how lowly valued these things are. and they've started to come in the market and bid for companies. So that's been, you know, one strong feature. The other one I alluded to earlier on, and it was the share buyback. So UK companies themselves have been buying back companies, buying back their own shares very aggressively, and that has created demand for UK companies. So that's I think that probably I will leave it there, and I'm just going to finish with a few stock examples, trying to again ram home this point about how extreme the start point was, and why you shouldn't anchor off that point. So let me give you some examples. NatWest, which we talked about earlier on. In the financial crisis, we all probably remember 2008 and how horrific experience that was. The day before the UK government came in and nationalised what was called Royal Bank of Scotland back in those days, of course, the share price was £1.25. There's been a consolidation since then, but it was about £1.25. In 2020, during the pandemic, it was £1. So the share price of NatWest, despite the fact that the thing had been bailed out, you know, totally different management, much better balance sheet, much better loan book, the share price was roughly the same price that it was in 2008, in the middle of the financial crisis, when it had to be rescued. Just amazing. For information, the share price today is £5.10. Marks and Spencer's, another big company within the trust. During the pandemic, the share price of Marks and Spencer's bottomed at 90p. If I look out to next year, obviously this year's earnings have been affected by the cyber attack. If I look out to next year, the earnings per share forecast is about 35p, and yet the share price bottomed at 90p. Again, you know, you can see just very extreme overreaction. Two final examples, and these ones actually you don't need to go back to 2020. Here I'm going back to the start of 2024 to just illustrate some points. Currys, the electrical retailer, share price at the start of 2024 was 44p. Currys are forecast to make earnings this year, so only 2 years later, of 12p, and yet the share price was 44p at the start of 2024. And final one, IAG, which is I mentioned earlier on, British Airways, share price at the start of 2024, £1.50. The earnings in sterling this year for 2025 are forecast to be 60p, and yet the share price was £1.50 at the start of 24. Share price today, by the way, £4. So hopefully, I'm going to kind of pause there, but hopefully you get the message that I'm trying to give to you. We have just seen some very ridiculous share prices. The fact that those have started to correct does not tell you that the game is over. Thank you very much, and happy to take questions.
Brilliant. Well, that's great, Ian. Thanks very much indeed for the run through. Very much enjoyed the update on performance, the update on the banks, and the outlook from here. A couple of really interesting long-term charts that we saw there, which, well, as well as being informative, put the markets in context very well. I think it's always surprising how long cycles actually do last. So very useful. As I said at the start, we've got a Q&A button which allows people to ask questions. I'll do my best to get through as many as I can, and I will try and lump them together as well when they also have a shared area of interest. So to kick off, Ian, in which areas or stocks are you seeing cyclical margin pressures, and are there associated opportunities from normalization?
That's a good question. Do you know what? Surprisingly, at the moment, we are not, and I sort of almost hesitate to say that because it's almost inviting disaster, isn't it? But you know, let me give you a couple of examples. You might have thought, mightn't you, that I think we all know that government policies over the last year have probably not helped the consumer. National insurance has gone up, inflation's going up, real incomes are not going up, and therefore you might have thought, mightn't you, that would feed through eventually to the retailers. Well, in the last few weeks, we've seen Currys report profits way above expectations, upgrade their estimates for this year. And yesterday, Kingfisher, which is B&Q, doing exactly the same thing. I mean, that would have been I would have thought an obvious area where you would have thought you were starting to see pressure come through. Quite the opposite. They reported much better earnings. They upgraded their forecast. At one stage yesterday, the share price was up 25%. So that area we haven't seen it. Financials, we've not really started to see it come through. Maybe a little bit in the more commodity orientated sectors. So energy and mining. Obviously the oil price has come down a little, so maybe we've seen it start to filter through into those sectors. But by and large, actually, at the moment, things appear to be behaving reasonably well.
Great, thank you, Ian. Unsurprisingly, I guess we've had a couple of questions on the banking sector.
Yeah.
One of them, in fact, no, I lied. Two of them are on the topic of an increasingly desperate chancellor and the prospects of tapping the sector with a windfall tax, and whether that's currently priced into the market. Do you have a view on that?
So I don't have a view on whether she's going to do it or not. I mean, quite possibly. I think it would be a really bad thing to do. I think it would literally be hoisting the flag around the world to say that we don't want business to come to the UK if we're going to start doing things like that. But then again, it doesn't mean she's not going to do it. She's already done, in my opinion, quite a few silly things. I suppose I would just make 2 points. Number one is that if these things were really highly valued, then yeah, I would be concerned about it. And hopefully, what the message that you've got from the last half an hour is that they're not, and therefore, to a certain extent, I suspect it's kind of being factored into the low valuation. That's point number one. Point number two is that I mentioned earlier on that we have been recycling money out of these, so actually we have lowered the weights of them, so they are now not such a large part of the trust. And just as people might be interested to know what we've been doing with that money, I'll maybe talk about some of the things we've been buying recently in a second. But we've actually recycled some of the money into Korean banks. Now, people might be surprised. What on earth is a UK income trust doing buying Korean banks? Well, Temple Bar has the flexibility to go 30% overseas. There were two banks that our analysts identified that they were called Hana and Woori. The banks themselves were very, very high quality banks. So what do I mean by that? They've grown very consistently. They have very conservative lending policies. The balance sheets look very, very strong. The Korean economy is actually one of the few economies around the world today that's doing relatively well. The Korean government have just introduced a policy in which they are encouraging companies to become more shareholder friendly. So you put all that lot together, you might be surprised if I told you that these things were trading on price to earnings ratios of 4, price to books of 0.5, and dividend yields of 8. And so that to us seemed to be quite a sensible way to kind of diversify some of the money out of the UK banks and into another area where we were getting what we think of some quite attractive banks, high dividend yields, and sort of low valuations.
Great, thanks, Ian. Well, let's move on to 2 or 3 questions we've got, which are on a more stock-specific basis. Smith & Nephew does not strike me as the obvious value stock. I'd be interested to hear your take on it.
Yeah, glad someone asked that. Because, by the way, I completely would agree with you. And again, I suppose I would just reiterate the point that we, in the opinion of myself and Nick, value investing is not just about marauding around the market buying all the low sort of price to earnings companies. It's about looking out in sort of 5 years hence and asking ourselves, where do we think the earnings can get to on a 5-year basis, and basically valuing the business off that. And that's very much the case with Smith & Nephew. So let me just give you sort of 1 minute on Smith & Nephew for people who don't know it. Smith & Nephew basically has got 3 main businesses. One of it's called sports medicine. So that is basically if you, I don't know, do your cruciate ligament or something like that, they are involved in, in that sort of area. One of it is called advanced wound management. So that is things like if you're having an operation, the sorts of things that they use to sort of stem the bleeding and so on and so forth. Now, both of those businesses, in fact, if you can see this slide here, if you look at the pie charts, these are both business industries that are very consolidated. So in other words, there are literally about 3, 4, 5 companies who effectively have all the market share. So Smith & Nephew are one of them. You've got Stryker, Johnson & Johnson and Zimmer tend to be the companies who dominate these areas. Very high quality businesses. So they grow their top line at sort of 5% or so, and they make 20% type margins. So really, really high quality businesses. And then they have a third business, and the third business is the problem area. The third business is called orthopedics. So orthopedics is basically things like hip replacements, knee replacements, that sort of thing. That business went wrong, inverted commas, during the pandemic. I won't go into the detail, but they basically got various things wrong. It was partly to do with sort of the products they had. It was partly to do with sort of stocking and so on and so forth. And they lost a lot of market share. And the share price got cut in half from the peak as a result of this. I suppose the investment thesis here is that there's been a change of management. New management team has come in. They put in place a 12-point plan. 6 of the 12 are aimed at improving the profitability of that orthopedic division. We think that if they are successful, that basically profits will rebound. And that was the thesis for buying the stock, and it is effectively I suppose our belief that they can be successful in doing that. And when you look 5 years out, the stock actually looked quite cheap on that basis. Now, the last couple of sets of results actually have been very, very promising. It does appear that the new management team are starting to see that orthopedics profits have bottomed and are now recovering, and the share price has responded quite well. I think the one final thing that I do like about Smith & Nephew, by the way, is from a portfolio perspective, it was, again, quite nice to recycle money out of the banks and into areas like this. So Smith & Nephew, not particularly reliant on the UK economy, well, not reliant on the UK economy at all, actually, not particularly cyclical, very high quality business.
Great, thank you. So moving on to another stock, Stellantis. Do you still own Stellantis in Temple Bar? And do you think the relatively muted reaction to recent negative production news suggests we may have exhausted selling pressures?
Yeah, I hope so. So the answer is yes, we still own it. Stellantis has been one of our worst investments. It's quite a remarkable story, actually, because when we bought it, I think we bought it on a price to earnings ratio of about 2 times for a company that had a third of its market cap on cash on the balance sheet. And yeah, it's still been a very, very disappointing investment. Part of that is undoubtedly just because of the industry pressures. So there are various different things going on, aren't there? One is obviously the transition from petrol and diesel into EVs at a time in which governments don't seem to know which way they're going. Obviously, we've had some governments say, right, we want all that done by 2030. We've had other ones sort of starting to move the goalposts. That makes it very, very difficult for these companies. If you are planning, massive new factories, how on earth do you do that when governments keep moving the goalposts? So that's point number one. Point number two is Chinese competition. I guess we all know that companies like BYD are now making some very, very good cars, and they are very, 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 very cost competitive. That makes it very, very difficult for companies like Stellantis. And then there's a final thing, which is that we actually had a call with the company a few weeks ago, and they again have had a change of management. I think there was an admission that the previous management were maybe too focused on keeping margins up, and therefore they basically ceased certain lines which were huge sellers in the US. There's a model of the Jeep in the US which used to sell more cars in the US than total cars sold in Germany, and yet the old management team ceased it because it was a low margin model, and they are now reintroducing that. So combination of those things, I think the valuations now look very, very low. I think probably people now appreciate all the pressures the companies are facing. And the final thing is that I think the company actually, with the change in management, have started to react to some of their own self-help, so the mistakes that they made themselves, and have started to take steps to improve profitability. So fingers crossed. No, sorry, final thing. We absolutely it was wrong to purchase this thing, but at least we did not make the mistake of just doubling down and doubling down and doubling down. We basically just, we took the initial position and we basically let it sort of, I suppose, dwindle within the portfolio rather than just continuing to buy it and buy it and buy it.
Understood. Thank you. So another stock-specific question, this time on Johnson Matthey, and
Yep.
you've maintained the position despite a very rapid and sizable return soon after introducing. How do you see the valuation now?
Yeah. Again, this is a fascinating one, and by the way, both myself and Nick would hold our hands up and say we were very lucky with the timing here. But again, for those who don't know, Johnson Matthey is basically it's a refiner and recycler of platinum group metals. So what do those mostly go into? They mostly go into catalytic converters, don't they, for petrol and diesel cars. And obviously the concern for the market was that as we go from petrol and diesel towards EVs, the demand for that will go down. And so the stock had done poorly for a number of years as a result of that. But moreover, the company themselves had basically taken the cash flows from that core business and they tried to diversify into other areas like hydrogen. So they were basically spending enormous amounts of money on trying to diversify away from their core business. And it wasn't working. So they were basically committing huge amounts of money into areas that were just producing massive losses. The interesting, I suppose, catalyst here is that there's a company called Standard Industries, who are a US company, and they've got an investment arm, Standard Investments. They took a stake in Johnson Matthey, and they basically started to agitate very, very aggressively. You can go on if you just type, Johnson Matthey Standard Investments into Google, you'll find some of the letters to management that they sent to Johnson Matthey management come up, and they were very, very direct. They basically said to them, "You have got to stop, frittering away shareholders' money on these sort of foolish diversifications, and basically focus back on your core business, work on getting costs out and getting your margins up." And we took a stake in the company at the start of this year. When we were buying it, the market cap of Johnson Matthey was about 2 billion. Okay, so what then happened? What then has happened is it appears that management have actually taken on board what Standard Investments have said, and so they've started to do some of the right things. But the major thing that happened here, you can see at the bottom there, is we walked in one morning and they announced that they'd sold one division, and that division is called Catalyst Technologies. And Catalyst Technologies accounted for about 20% of the profits of the company. Honeywell, who is buying it, are paying 1.8 billion sterling for this business. Now, having just said the market cap of the company was 2 billion, you're getting nearly the market cap of the company back in one transaction. And of that 1.8 billion, they said they're going to return 1.6 billion. So that will come back to shareholders in the form of probably special dividends. That immediately prompted a big, I think the share price went up literally about 30% or so on the day. In our opinion, all the market has done is basically reacted to that one transaction. We still don't think that the market is pricing in all the other stuff. In other words, the improvement of profitability that is likely to come about from management now focusing back on the core, taking costs out, improving margins. We also think that the market is probably being way too pessimistic when it estimates the decline in demand for platinum. Our feeling is that probably platinum demand will tail off over a long period of time. That won't be the sort of cliff edge that the market was maybe expecting. And that's really the reason that we're still holding it. Again, actually, this is another really good example, I think, of just how extreme some of these valuations have become. When this thing is was valued at 2 billion quid, and then they sell one business for 1.8 billion quid. That that tells you that the market was being pretty pessimistic about the company.
Great, thanks, Ian. You did talk about Korean banks, and we've had a question on overseas exposure, but I think just to sort of preamble into that question, could you just remind us what your overseas exposure is currently within the fund? And then the actual question is, do you neutralize currency risk?
No, the overseas exposure, I think, is about 29% or something like that. And as I said, we're allowed 30%, and we're utilising most of that. The answer to the currency one is no. We don't sort of hedge currencies or anything like that. I think there are a couple of reasons for that. Number one is we would be the first to say we have no skill whatsoever in forecasting currencies, and therefore, when you start hedging out currencies, you are implicitly taking a bet. And the second one is, I think, when you look across the portfolio, you've got a pretty diversified currency mix across the portfolio. Because go back to the Smith & Nephew example, even though that is a London listed company, very little of its profits come from the UK. And ditto with the energy companies and healthcare companies and so on and so forth. So when you consider the portfolio on a holistic basis, you've got quite a diversified mix of currencies across it. And so again, we don't see the upside in hedging out currency exposure.
Understood. Thank you. So we're going to move on to a couple of more general questions. Tariffs has come up as a topic, unsurprisingly, and just wanted your views really on difficult question, but the impact of tariffs that are out there at this particular stage on the fund. Do you have a view?
So far, not too bad, actually. I mean, obviously, lots of things got clobbered after Liberation Day. When share prices we're talking about here. And then obviously Trump stepped away from the brink, didn't he, to a certain extent. What we eventually got was not nearly as bad as he'd been threatening at the start. So that's point number one. But point number two, actually, we haven't really. I'm not really aware of that many companies who have come out and said, no, this is going to be a disaster for us. So far, touch wood, there doesn't seem to have been a very dramatic impact.
Great, thank you. Another sort of general question, but sort of referring to the slide you showed on the previous three bubbles going back 50 years.
Yeah.
And the one showing, I guess, the valuation of the US and the Mag 7 now against the previous bubbles.
Yeah.
The question is, however, previously there were very limited or no global market facilitated by internet, apps to trade, other tech gizmos, I guess, as well. Both professional and retail investors have increased a lot since. Do these issues matter at all? Do you have an opinion on that?
Do you know what? They matter insofar as I think it's part of the reason that this bubble has become so extreme. And this is something that I've written about over the last few months. This being that, as most investors in the trust will know, for myself and Nick, valuation is the cornerstone of our process. Valuation is basically everything that we do. As time has gone on, we have become increasingly rare. There are now very significant market participants for whom valuation is almost irrelevant to them. So let's think about passive. For passive investors, valuation is utterly irrelevant. They literally will buy whatever is the weight within the index. So valuation plays no part at all. In fact, to a certain extent, you can say actually what they're doing is they're allocating more money to the more highly valued parts of the market, because that tends to be the bigger part of the market. So that's number one. What are called multi-strat investors, sometimes called pod shops. Again, these people literally are trading on a sort of 24-hour basis. Valuation utterly irrelevant to them. The retail investors, particularly in the US, your sort of Reddit crowd, your Robinhood crowd, again, short-term traders, valuation utterly irrelevant. And I think that is why, to a certain extent, we've seen such extremes go out in the level of overvaluation. And my view is that in the long run, that is good for us, because what Nick and I need is lots of securities to be mispriced within the stock market. Now, if there are whole swathes of the investment community who no longer bother to value things at all, it stands to reason you're going to have more mispriced securities within the market. And, you know, hopefully I've given you lots of examples over the last sort of 40 minutes or so of things that we think got ridiculously mispriced. And my suspicion is that it's because of the change in nature of market participants that we've seen that huge mispricing. So in the short term, probably that means you get more volatility. In the long run, I suspect it actually means that our opportunity set widens.
Understood. That's great. And we're coming to the last question at the moment. So it's on share buybacks actually. And are there any observations on, just given the weight of share buybacks that are out there at the moment, in terms of impact on share prices in the first half of the year when you see them?
Not specifically. I mean, I suppose, hopefully what came across earlier on was that we think that done correctly, they are a very good form of capital allocation. What do I mean by that? If you have got a strong balance sheet, you're generating cash, and your shares are trading at a very low valuation, and you're already spending money on capital expenditure, etc., so you're not starving the business. Using excess cash flow to buy back your own stock is a very, very good thing to do. And we went through the example, didn't we, of the banks earlier on and how positive it's been. Sometimes you will see where the market was not expecting a share buyback, and then a company basically says we are doing a share buyback. You will see a positive reaction. Actually, Smith & Nephew is another example of this. They announced a 500 million share buyback. I think slightly earlier than the market was expecting, and I think that was part of the reason that the share price reaction was so strong. So, at the moment, yes, we think it's positive. I would just add, though, that we're not universal fans of share buybacks. We think that there are good and bad share buybacks. So bad share buybacks, people buying back stock basically when their shares are highly valued. I would point in the direction of some of the US technology companies who are buying back their own stock, despite the fact that their own stock is very, very expensive. And another fascinating thing, if you look at some of the look at some of the Mag 7s, despite the fact that they've done very, very large share buybacks, you might be surprised to find that their share count hasn't gone down in the way that the share count of sort of NatWest and Barclays has gone down. Why? Because they're issuing shares to their employees. So they pay their employees by issuing stock, and then they basically buy back stock on the other hand, and the two just net each other off, and the share count doesn't go down. And again, to me, that is an example of sort of a bad share buyback.
Yeah, completely understood. Well, Ian, look, thank you so much for your time today. That's a really very thorough run through. And ladies and gentlemen, of course, thank you for your time, taking your time out in your schedules to listen today. We hope you found that useful. In summary, we're approaching the end of October, very important for this particular fund. We're going to get a 5-year track record for the Red Wheel team, and that track record is going to be strong. So number one over 1 and 3 years, and if I was a betting man, it's going to be a good record over 5 years as well. The yield has been enhanced recently by looking at the chairman's comments in the year-end report for March. Have a look at that. Enhanced, of course, by the share buybacks taking place in the UK equity market over the last few months. And me, as being a relatively sad person, I can tell you now, on Tuesday, out of 521 London Stock Exchange announcements, 187 of them referred to share buybacks. The market cap of the fund, ladies and gentlemen, has reached £1 billion at £3.51.5 for the mathematicians amongst you. So those of you who like scale, this is a fund that has it. UK equities are trading at one of the lowest valuations for 50 years still, even though we've had some pretty decent performance in recent periods. So investors who are considering their UK allocations should really focus on this, and they should focus on Temple Bar as a very credible, differentiated option, particularly if you're holding it alongside ETFs, think that's highly complementary for your clients. So look, do come to Frostro or Red Wheel if you've got any questions in regards to the fund. And of course, do contact Cavendish, who are the house broker for the fund, to place an order. The ticker is TMPL. Thank you for your attention today, and until next time, look forward to speaking. Thank you.
Thank you very much.